Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then, we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome, everyone, to episode 25 of Offshoot. Today, my guest is Josh Volen, the principal and co-founder of CIRE Equity, an $890 million NAVREIT. Josh graduated from Cal Berkeley, then spent 6 years at Marcus Millichap, where he became one of their top brokers. In 2010, he started CIRE. From 2010 to 2019, their acquisitions were funded entirely through high net worth syndications. Then in 2019, they combined 13 of those assets into this NAVREIT, which functions just like the Blackstone BREIT in that it's not on the public markets, but does offer mark-to-market transparency and limited redemption opportunities. In fact, they call this the C-REIT for CIRE. In forming with the NAVREIT, they also partner with a broker-dealer to really boost their growth. Josh is super unique. He's got a deep expertise in the hard science of finance and real estate, as well as a rich understanding of people and culture. Weaving these two strengths together has created a really powerful platform that I honestly suspect is just getting started. Because it didn't come out in the pod, for those of you who might be interested in investing with CIRE, it's CIRE, Commercial Investors in Real Estate, and you can find the group at cireequity.com. Listen in as we cover topics that include how 6 years in the boiler room of a Marcus Millichap brokerage shop really added to Josh's skill set, how CIRE viewed themselves as operators, not capital allocators, why Josh's primary job is replacing himself a little bit more every day, how successful remote work requires being intentional with accountability, solid meeting rhythms, and robust meeting structures, how their underwriting process is first, what they could lose, second, base case, and third, upside. How CIRE Equity is really just a professionally managed family office that's nimble enough to beat other institutional capital allocators, the fee structure in their deal offering, the compensation offered to CIRE's employees and how that drives alignment, how health, wealth, and security are core components of what's being offered to the CIRE team, how core values inform the day-to-day operations of the company, and how those core values are the North Star of what they do and how they function. Why hiring better than yourself is critical, and finally, the importance of showing up for yourself first, being present and clear, setting intentions, reminding yourself of important affirmations, and continually learning. I really enjoy this conversation with Josh. I hope you do as well. Josh, welcome to the podcast. Thanks for joining me.
Thanks for having me.
Yeah, I got you bright and early on a Saturday morning, so that's saying something. Thank you. I appreciate it.
Whatever it takes for a friend.
Oh, that's awesome. Hey, so CIRE Equity, obviously we've known each other for a while, but for myself and the listeners, can you just kind of give an overview of what you guys are up to, what you do?
Sure. So founded CIRE Equity back in 2010. Nothing original with the name when CIRE, it's Commercial Investment Real Estate is what it stands for. But founded in 2010 after being a broker for 6-7 years, and always knew I wanted to be on the principal side. But what we do is we're a vertically integrated owner and operator of commercial real estate around the nation, with our main product or offering being a non-traded NAVREIT. So that is our focus. And again, commercial. So retail, industrial, net leased, some medical office, not a lot of multifamily.
The NAVREIT is it's a new thing, relatively new for CIRE, right? You had if I don't have it too wrong, you had a kind of previous iteration of the way you were going about it, and I believe there was liquidity point on that, and then you came back with the NAVREIT model.
Yeah, so founded the company in 2010 with my business partner, Trevor Smith. He's based up in LA. I'm here in San Diego. And, 27 years old, starting a company, coming out of the GFC, where a lot of blind funds didn't do very well. Just made sense to do deal by deal when we started off. And so we would, syndicate deals, pass the hat around with friends and previous clients from my brokerage days and people we knew and met. And so raised deal by deal from 2010 up until 2019 with the end goal that we had built some scale with those deal by deal offerings to where we would send an email out, call it on a Thursday, and by Tuesday, raise $20 million, $25 million, which was no small feat, having a couple hundred investors in the queue and a good following. But had the scale of these deals or a sizable company at that point, just weren't getting the benefits of that on the deal by deal side, right? Every deal has a different lender, every deal is holding special reserves, every deal has that singularity protection, but also risk, right? So from a durability of cash flow for our investors, things like that, it wasn't meeting all those needs. And then from a scalability of a company side, not to say you can't do deal by deal forever, it just wasn't providing the scale that we wanted for ourselves and for our investors. Because we would go and, you buy a deal, you operate the deal, it's performing. But at some point there's a liquidity event that investors are looking for or not looking for, right? So even if they're not looking for it, you sell an asset and then you're not 1031ing those assets because of the complexity most of the time. And the investors are like, thank you for a great return, but I'm mad at you for giving me my money back. Now where do I put it?
And I've got a tax bill.
Exactly. Now I have a tax bill. And so just structure-wise, it didn't make sense. We always, from the inception in our vision planning and strategy, it was to build an evergreen product at some point. That could have been an MLP. There's different partnership structures, but NAVREIT was on that list, which I had been exposed to from the brokerage side from some pretty large companies that use that. And it kind of answered all the objections from my client days working with high net worth, ultra high net worth, family office type of clients, and even institutional clients mandating some type of REIT structure to simplify, taxes and simplify reporting. And so in 2018, actually came to terms with a group out of Chicago to help launch the NAVREIT, and we rolled up 13 assets that we currently owned into this NAVREIT structure, which NAVREIT is net asset value. So it's just it's an equity REIT and real estate investment trust. It's non-traded versus publicly traded. I'm sorry, non-traded versus traded on the public markets. So the way you subscribe is through accredited investor subscription process, 506B or 506C offerings. It's all still paperwork, right? And you still have to have qualifications, but for all effective purposes, we're similar to a public, a traded REIT, except our liquidity is on a quarterly basis. Our dividends are distributed on a quarterly basis. And it's just not the minute to minute or second to second liquidity you have in the trade markets. But anyway, we took these assets, we rolled it in, 13 to start. And by May of 2019, we had launched the NAVREIT. And we've been growing that product ever since. We do have some offerings outside, but that's our flagship offering. It's C-REIT. If you've heard of Blackstone's BREIT or Ares A-REIT or Starwood's S-REIT, we're not us real estate people are, I guess, not very creative in naming. And we're CIRE C-REIT. So
cool. And you just mentioned some of the attributes there, right? It's non-publicly traded. It's for accredited investors. They've got to qualify. It's quarterly distributions and quarterly redemption. But we spoke a couple of weeks ago, and it seemed like also on the incentive structure, in terms of anybody who's running other people's capital, there's always some sort of an alignment there that gives them a reason to come to the office every day and aligns them for optimizing the profit of the the enterprise's holdings. It sounded like the NAVREIT has a pretty unique structure in terms of getting compensation to the management team, both in terms of overhead and also sharing in the upside. Can you kind of get into how the mechanics of that work?
Yeah, I mean, so the structure on the NAVREIT is we have a 5% pref hurdle, and then it is an 80-20 with a full catch up on that. So aligned, right? You have to make money to earn money from a sponsor perspective. The promote is paid out and crystallizes on an annual basis, because what happens in these perpetual vehicles or these evergreen vehicles, NAVREITs and others similar, is we're marking to market, right? And so on a monthly basis, we're doing market valuations and marking to market. Our third party evaluator today is CBRE, doing all of our appraisals. So every asset needs to have a full appraisal at least once a year. It can be more than that, but it's at least once a year. And it's mainly being done off of a discounted cash flow analysis. So the valuation shouldn't be shifting a tremendous amount from stabilized assets versus a value add. It's mainly the discount rate that's being used. So fluctuations in the interest rate environment, things like that, may move cap rates or the discount rate used to value the properties. Or if there's a shift or loss of tenancy or an upgrade in tenancy, that will move value. But mainly it's cash flow, and then some type of event valuation scenario where it appreciates or is written down. But yeah, 5 pref hurdle, 80-20 with full catch up. We have our asset management fee is 150 basis points, and then PAQ, so acquisition and dispo, of 1%. That's kind of the fee load on it. But since inception, so now we're 5 years in on operating, which is comparable pretty much with any of these others, if not longer than most of the NAV REITs out there. We're performing at a net 12.8% net to our investors in this, with a current dividend target of about a 6.1%. And since inception, that would be about only 2% of our total return has been taxable. So it's all the rest, the dividend to the total return, has been tax deferred. So that's pretty meaningful when you think about it.
And then that when the promote is paid out, is it paid in? I mean, it doesn't seem like it could be paid in cash, because you're only kicking out, say, 6% of a 12% return. So how is the promote paid? I thought there was kind of a unique structure there as well, right? If you're crystallizing a promote every year, what does that look like?
Yeah, I mean, technically you could take your promote in cash, right? And the 6% is not the total, call it FFO, or the total income that comes into the REIT. So the way the REIT status works is you have to pay out 90% of your taxable income, right, to qualify for your REIT status and not to have to pay the double taxes. And but because of the beauty of commercial, of real estate, having the interest write-offs, the depreciation or accelerated depreciation as well, our taxable income is much lower, right? So when we pay out a 6% dividend, again, that 6% dividend is not just on your starting investment that you put in. That 6% dividends on what your investment's growing to or has grown to as well. So that's one of the catch-22s with the NAV REIT structure, but we can get into that. We will have excess cash flow, and excess cash flow goes towards more investments, right? We just target a 6% dividend. We could target a 4%. We could target a 5%. Most of our competitive sets targeting somewhere between 4 and 5. We are one of the, if not the highest dividend provider out there. So kind of a fixed income alternative that's tax deferred, right? So, me being in California, and maybe someone in Illinois or New York or some other states, even if you're just in a tax-free state, right, the 37% Fed tax on your income, a 6.1% dividends equivalent to almost a 10.4 pre-tax, right? And if you're in California, it's nearly double. So 6 is like a 12.
Mm-hmm.
Some higher tax brackets. So to have that from an income producing, durable income and passive cash flow to an investor standpoint, it's a phenomenal vehicle. And also just from a compounding nature. I mean, that's what real estate's about. It's about the building wealth through time, over time. It's a long-term investment. So to be able to have earn 6 and then call it total return of somewhere in the 10 to 12 range compounding, it's pretty powerful, right? Just from a wealth generation. But you're taking illiquid assets, Kevin, right? You're taking illiquid assets in all of these instances and you're making them liquid to some degree, which is kind of an oxymoron, right? Like that's where the public markets are not. I keep saying public markets. We're going to be publicly non-traded here probably in the next 18 months because it's just a natural conversion. It's more about size of fund, number of investors you have to become publicly registered.
Right, but you're not publicly traded on the open exchanges.
Correct. So the difference is traded versus non-traded.
Right.
But like the traded ones, like if you think about it, you're taking an illiquid asset class like real estate and you're making it fully liquid second by second. So volatility, if you watch the traded markets, the volatility is actually more volatile than S&P 500, right?
Mm-hmm.
You're talking about a 22 volatility factor versus the private real estate market average is somewhere in the low 5s. We happen to be slightly better than that in the low 4s, right? But it just, and that's still providing liquidity, right? Versus, some other private funds that have no liquidity until you sell something or refinance a capital event. So it's just an interesting structure. It's also to protect investors, going back to how we get paid and how we're aligned with investors. There's a high watermark, right? So we only get paid on when we generate profits. It's not, so if one year we're up 20% and the next year we're down 20%, we don't make anything in that down 20% besides the asset management fees or acquisition disposition. That's just operational fees more than anything. We have to get above that dip to get back.
In order to get back to a promote.
Yeah, so it's high watermark.
But I want to go back to what you said about the dividend or distribution or both are based on the net asset value. So try to make a simple example. Let's say there's $1 billion day 0 and you grow 10% for a couple of years. You're at 1.21 or something like that. Billion. That 6% that you're paying out is based on the 1.2, not on the initial 1 billion.
Correct.
So, I mean, everybody's going to have their own calculation as to what that really looks like for them. But it sounds like over time, you would expect an individual investor, I mean, assuming the journey continues to be accretive, to be doing quite a bit better than this stated dividend on the net asset value. Right. So not 100%. Yeah, it's not their basis, it's the asset value.
Well, I think it's just a fundamental investment principle, right? People typically quote back what they're returning on investment versus returning on equity, right? So they're like, I'm making 20% cash on cash. It's like, no, you're not. It's not possible unless you're saying your asset's a 20 cap or if it's unlevered or if it's a 10 cap with 5% financing on it or something, right? Getting out the gate. But when you mark something to market, that's your return on equity, or marking your equity to market and then using that as your denominator, the return should be lower, right? Because there's an opportunity cost of holding that asset each time that you take those dividends. And so paying 6% over time, we've had through Q2, I can give you some stats. Through Q2, our numbers are 15 quarters of increased dividend, right? So if you invested $100,000 with us in early 2019 through now, you would have started off, call it around $1,700 or $1,600, quarterly distribution to now where it's $2,800 today.
That's interesting.
Like
the structure you're talking about by marking it to market forces you to recognize the actual equity in the deal and then the yield in the equity rather than stating your yield on your basis.
Yeah, I mean, it's actually part of the education
Uh-huh.
for our previous investors, right? Or how with investors in general, because they're like, oh, it's only a 6% dividend or 6% cash flow. I'm getting, again, they go back to, I'm getting 12% or I'm getting 15% with these guys, but that's like a closed end fund. You know, like say you bought a multifamily building, right? In 2019, 2020, it's appreciated, right? And they're going, well, I'm getting 20%, 15% cash on cash. It's like, yeah, but your $100,000 is what you're using for that. If the building doubled in value or tripled in value, your equity, 2 times in value over the last 6 years, and your hundred's now 200 grand, and you're getting 14%. You're really getting 7.
That's right. That's right. Um, that's all very helpful. Thank you for getting into that. And then as far as, one of the things that I think you shared with me is, I believe you guys as principals have a pretty significant co-invest. Like your money is also next to the investors, which, as an external investor looking at something like this, one of my main questions would be like, well, how much do you guys have in? And I'm not asking that question, but I did kind of get a sense that you guys are materially invested alongside all of the third-party investors.
Absolutely. I mean, part of the formation, the reason to do this was exactly that. I wanted to go, starting the company was to be on the principal side and was to earn passive cash flow and to be able to sit on the beach and still earn, right? Like that's part of my story of getting into real estate in general. Commercial real estate is to build wealth over time. And one of the best wealth building vehicles or freedom generating vehicles was commercial real estate, right? And so to launch the company and then to further launch the REIT solved, in my opinion, again, how I thought of that with my partner was, dealing with all these family offices and that first generation generating a tremendous, generating some wealth for the family and for the legacy. And then they were the operators of that real estate. And then second generation comes along. And not all generations, not all kids are created equal, or not all interests are aligned to continue to manage those assets. And so you'd see some degradation between, G1 to G2, right? And God, willing, it gets to a third generation potentially at some point still and be intact. I mean, that was super rare. And so I saw a lot of my clients being those, G1 or G2 clients, and you go from, a patriarch or a matriarch or a family having, 2 kids, and those 2 kids go into 7 grandkids, and those 7 grandkids go into 30. There's just a problem from an estate planning side, right? Besides just operating the assets itself, the actual estate plan becomes difficult, and you have illiquid assets, and then you have an event of passing, and now you have differing needs and alternative wants from all these trustees. It creates a misalignment, and it creates from a buyer standpoint, it creates an opportunity, right?
That's right.
The death, distress, dissolution of partnership, all those D's of motivation. It creates one of those opportunities. And for the people that, we're supposed to benefit from all this hard work and, over time, usually it creates infighting and lawyers and CPAs and other people benefiting from it, but not the actual trustees themselves. And so part of the solution there is not knowing if I was going to, I was definitely wanting kids, but not knowing, what that looked like with having kids. And I didn't want to set my kids up for that. It's okay. I wanted to build a professional platform, an institutional style platform with the entrepreneurial nimbleness that a family office may have, and a viewpoint that's aligned with other, call it family offices. So like a multifamily office vehicle that had liquidity provisions that mark to market, that paid current cash flow, but was always optimizing, right? And that was aligned to do so. So how do you professionalize a family office effectively? And that's effectively what this REIT vehicle is, right? Between me and my partner, we're over 16% of the common share ownership, right? I'm the largest private shareholder today. And I've reinvested twice this year with additional money besides our DRIP, or direct reinvestment of our dividends. So very much believe in it. This is long-term focus, and really it's just to build cash flow, right? It's a cash flow machine and very tax efficient compounding. And if something happened to me, God forbid, then if the charities we support or kids or any other trustees, right, they have shares and they have cash flow dividends coming out on a quarterly basis. And if they needed liquidity, they don't have to sell a full asset. They can sell some shares, right? If you had think about it. If you had, you have two kids, right? And you own this, let's say you own one really nice triple net asset. I won't use Walgreens because I don't think that's a great example now today, but call it a solid asset. And one kid needs some cash or something. What do? You got to try to refinance, right?
Right. Or do a buy sale.
Buy sale, like that just, and it's and at a time when you really need that, or you're not thinking clearly, you're in distress because you just lost a family member. Like that's just not
right. And then maybe they're in a tenancy in common and they need both parties to consent, and one of them's not going to. So then here comes a partition action, and yeah, I've seen all that.
Lawyers win.
Yeah, lawyers win. That's exactly right. So, going through the idea of this being a more permanent and almost like defensible execution around your own family office, obviously with the ability to bring in external capital and grow the business enterprise on itself. How do you think about the management? Like, go back to, let's both forbid that something negative would come your way. What's the executive team look like? How does it happen that Trevor and Josh, have a really bad day and shareholders are still intact and the strategy is intact? And, how have you guys thought through that whole piece of it?
Yeah, no, it's a great question. So, people ask, what's your role? What's your job function? And my job function and all of our job functions for all of our team members to some degree in our company is to replace ourselves a little bit more each and every day. That's the responsible thing to do. In order for this to be a scalable platform, it can't depend on one person. It can't depend on two people. At some point you start looking around, you can look at your team, and sometimes you'll see a team member and they're a bottleneck to their own success, or they might be a bottleneck to growth, right, in some form or fashion. But when you're looking around, you got to look at yourself, because we could be potentially the biggest bottlenecks to our own success and growth by still being so involved in the day-to-day. Not to say there's not a value there, but in order, again, to scale, you got to pass that down. You got to give to get, is what I say to the team, right? Sometimes you have to give up some of the things that you're great at even to get to that next level. And it's all about that change management and moving through change, right? And elevating, and then also backfilling behind with mentorship and support, facilitation, delegation, and just leadership with people so that they can continue on. And so that succession planning is a big thing we always talk about. So we're looking at either automating, delegating, or eliminating in any situation. Is there something that we can automate to help, get more bandwidth? Something we can delegate out, right? That could be onshore or offshore talent. And then is this something we really still need to do? 80-20 rule, like Pareto principle. Is this actually driving the business forward? Or can this be backburnered in or eliminated from a process to simplify, right? Being a little more lean. So yeah, my job is to replace myself a little bit more every day. So that would be on the investor relations side as we hire people, on the acquisition side, the role that should be elevated up and still is, with getting input from a great team, hiring people better than yourself with different experiences and a varied background of people and experiences, is to make better decisions, right? And that's on the visioning and goal setting and trend seeking data analysis piece. But the team today is over 40 people in 7 different states and 4 countries, and we're fully remote / I guess quasi hybrid. I'd say we have some pretty nice storage offices, smaller spaces that are around in San Diego and Beverly Hills, Phoenix, and some other satellites, Houston. But for the most part, we're a hybrid to remote company that has great team members that know what success looks like, or that is the aspirational, that everyone knows what a great job looks like, but they have the autonomy. We're small enough to know you can't really hide, right? Because connected. We're all working together. We're fairly lean.
Were you guys remote prior to COVID?
We, so this is interesting. So March 12th, 2020, with my family for skiing up in Mammoth, and going back to the office on March 13th to close it down effectively. So San Diego was the main headquarters. It had the majority of people were busting at the seams. It had, 20, 30 people in that office. And March 13th, we closed the office down, and everyone had a laptop already except for 5 people, which was our accounting department, which is pretty interesting, right? So we only had to we sent those accountants home with desktops, but everyone else was already mobile to some degree. And if you think back historically, like Trevor, my business partner, and I, we've always been in separate offices. We've always been, right? So that didn't change at all. And taking that concept of a pretty archaic way of looking at things from just real estate moves very slowly and change typically. But, just looking at that, I was always questioning, we were always questioning as an executive team strategy wise, is why would we limit our talent pool to San Diego or LA, right? We wanted the best talent, wherever that talent may reside. And I think COVID just gave everyone, especially our firm, a good boost or kick in the butt to go, hey, this is that opportunity to test that. And we had to. And figuring that out, to be able to stay remote or a hybrid company really comes down to accountability and people knowing what they're supposed to be doing and feeling included and feeling like they have a voice and feeling engaged and having some autonomy. And it has to be built into the culture, and it is, and it has only been enhanced. It's not perfect in any way, shape, or form. I don't want to say that, but it's something we work on, and it gives us, I think, a tremendous edge to the market to go recruit talent wherever they may reside in the world, and to give flexibility to people that don't want to have the rigid, 9 to 5, if that's even really the work time anymore.
Right.
But
how do you think about, I'll just use that sort of well-used phrase of like water cooler talk. I can imagine if I was fortunate enough to be in an office with you for 1, 2, 5, 6 years, and just kind of hearing who you're talking to, how you're talking to them, what you're talking about, that just by proxy, I would pick up a lot in terms of the way that you think about and survey the landscape. And my experience of the remote thing has been, unless we actually bought little internet appliances. They're I think it's called the Echo or something like that, the Amazon Echo. So like if I were on a call with you right now and I had another associate looking through that window to me talking with you, then he might be able to pick some of that up, which is the virtual equivalent of him being across the hall. But that piece of just having proximity and letting junior people pick up, really like almost literally by osmosis, a bunch of decades of experience. And like I said, just that vantage point of kind of having made a lot of distinctions around a whole myriad of what otherwise might look like complex fact patterns to a newbie. How do you guys approach that aspect? Because like you look at a law practice, right? Like there's a reason, I think, that they all come together and there's senior, mid-level, and junior guys. And it's partly just being in the room and hearing like the art be refined amongst people who are doing the art on a regular basis.
Yeah, I've got a lot of thoughts on this. So there is definitely a benefit, and like you said, to learn through osmosis, to learn by just being in the environment or being around things, right? To pick up or hear nuggets here and there, but it's not intentional. It's very scattered and it's piecemealed, and I think that to some degree can be taken for granted, like that's actual training, but it's not. That's not intentional. That is just, you heard something and you might take that completely out of context or apply it completely incorrectly, right? And I believe training needs to be more intentional. And before, when we were in office, water cooler talk aside, which is more culture and just kind of the release valve, right? Like, it's nice to go to the office. Some people enjoy going to the office more than being at home, sadly, right? But you spend that much more time in the office too, historically. But, we had our offices was an open bullpen with glass offices because it was about transparency, right? Open door policy, like come in and talk to me whenever you want. But the truth of the matter is how many people actually took me up on that? How many people raised their hand and said, hey, I'm just going to go try to pick Josh's brain for the next 30 minutes or 45 minutes? No, they would wait for me. And I felt the obligation to come out of my office where I'm highly productive, come out and do a lap around the office and hopefully not be like Michael Scott, but like go around the office and do a lap 3 to 4 times a day, right? Like, that's not efficient. That's intentional, but it wasn't intentional. Like, I'm going to go sit with these people and just start talking about our acquisition strategy right now, right? Unless there was a meeting set up. So, there's a fatigue of setting up the meetings, but it's a slowing down to speed up thought process with intentionality of, hey, this is what we do. Here are our meeting rhythms. Truly our open Teams policy or open door policy that anyone can ping me, a lot more courage over email, a lot more courage over Messenger to ask a question than in person. That can be intimidating. Like, hey, I don't want to bother him. He looks really busy. They don't know what I look like. I could be in shorts with my hat backwards and a t-shirt, which is most days, right? But they can reach out to me and I can respond back and they know I'm going to respond back. They can see I'm online. They can see it's green, that I'm open, right? And they can send me a Teams, or they can call me, or I can call them. The amount of frequency and touch that I have with more employees, more team members today it's exponentially more. And our rhythms are better, right? Like, our intentionality around culture building and team skill building and technical skill building is more intentional. Could it be better? Absolutely. There can always be a better practice. There is no best practice at our company, right? It's part of our core values. It's persistent improvement. So overcoming and being gritty to improve, not just consistent. It's persistent. And quality performance, like, all these are built into our organization. And so, we have opportunities for people to learn. It's part of my goals every month. Again, part of succession planning is I have to be training and passing on this knowledge to others. So we have people that sit in on our acquisitions team calls every Friday, right? That, technically don't have much to do with the acquisitions process, right? They're getting to hear what's going on in the pipeline every Monday morning call where we have all hands. That's kind of like a stand-up, 15 minutes, call it, right? We go through pipeline. We go through what's changes or technology that's coming through the company, successes, opportunities, and challenges for the week. Like, it's just part of our rhythms built in, besides our monthly town hall meetings where we kind of do open format questions that happen at the end from the team. And we have our culture building, and that's our water cooler talk, right? We use something called Mentee to do surveys on, fun surveys on people's birthdays that are super competitive and funny, right? Like, it's shifting it, right? It's just the paradigm shift of being more intentional with it versus just spending time. It's quality over quantity, I think, is the best way to say
the intentionality, I think, is what I'm really taking away from you, right? If you're not able to have it by proxy and then it's important, then you need to reach through the computer monitor and make sure that there's a structure, a cadence, some sort of format to make sure that there is, in fact, even in that virtual setting, connection, right? Rather than like, well, Billy works in Omaha and hears from us every 3 weeks.
Yep.
Yeah.
Yep.
That's cool.
There's very little siloed. It's very little siloed. And the other thing too, Kevin, I think it's not a knock. I want us to be as high level critical thinkers as possible as team members. Right. And so not to say we won't get to this point, but it's a lot rarer positions that we're hiring someone just out of school, right? Or just getting into the business, like an internship program. I'd love to have a robust internship program to give back. We don't have a lot of internship opportunities, right? A, being in the office is one issue. And B, it's the big law firms, the big firms in general, they feed off of that young talent and they put them through the grinder, right? Get the 80 hours of, call it, grunt work out of them at a cheaper cost. And that's how the machine is fed. That's an archaic style in itself, in my opinion, right? Like putting some intentionality and thought process with that. There's a lot of automated tasks that you could put in. You want to use the buzzword AI. Before AI, there's automation, right? And so that's just having processes and having outcomes that you're targeting and building those into a repeatable task that should be automated before some human should be touching it, right? And so we're looking for that higher level thinkers and higher level doers, because you get more output and it's less consensus needed to move the needle and to, be an operator than, having 100 people, kind of doing the same thing. And next generation,
meaning
buying their time.
There's less kneading of the dough in order to create consensus, meaning like they already have the tools in the tool chest, and so it's easier to move together.
Yeah, I mean, it's like putting in a crew boat, putting 5 people versus putting 50 people.
Yeah,
the 5-person boat is much quicker, much more nimble, and will beat the 50-person boat even if they're all were rowing. Right? Like it doesn't work. It's too heavy, and so. I think that is just our approach today, at least. And I hope it doesn't change much in the future. Not to say I don't want, younger talent coming in. Like we definitely do have positions for that. It's just, again, it's highly intentional in the training, and that's a majority of our firm has experience. Like,
that's cool. Thank you for going into all that detail. I wanted to kind of focus on that structure and the REIT because it's super unique. I mean, there's the BREIT, the S-REIT, the A-REIT. Like those are far larger. Well, you guys are getting quite large also, but it's a unique product, and I wanted to sort of open that up a bit. But let's go into like the brick and mortar, if you will. What are you guys seeing right now in terms of opportunity? Where are you investing? Like, let's just talk straight real estate. Got the structure, awesome. But like, where are you guys in the marketplace? Primary, secondary, tertiary markets, multi-tenant stuff, value add, opportunistic, core plus. Like, what's the opportunity set? Where are you guys focused?
You just nailed it. You just named all
of
it. Our primary focus is right now has mainly been industrial. So our portfolio today is made up of multi-tenant retail shopping centers, primarily in the Southwest. So Denver West. That's what our initial roll-up was in 2019 was mainly 11 call it 11 shopping centers or so that we rolled into the REIT. So there's a couple million square feet of multi-tenant retail, which was really discount daily needs and services type tenancy, right? Your Sprouts anchored shopping center with your TJ Maxx, your Dollar Tree, your gym, your quick service restaurants and drive-throughs, things like that. And on the other end of that, we haven't bought a multi-tenant retail shopping center since 2019.
Okay.
So that, that piece of the portfolio that was, 95% of our portfolio on initial contribution is now less than 50%. It's actually closer to 40% of the portfolio today. The other 50 to 60% is made up of mainly industrial and net lease product. And a majority of that's industrial. So kind of a barbell strategy. And the way we look at that is industrial. We were looking at onshoring pretty early on in 2019 and distribution being a barbell to retail, right? So everyone talks about last mile, or that was the buzzword. Last mile has always been retail. I just think it's funny that they talk about it from an industrial standpoint, but the last mile really is retail because that is the most accessible location besides delivering to someone's home that's efficient, right? Because if you think about shopping centers, they're located right off a freeway with high visibility, high access points, high traffic counts, or inside a neighborhood, right? That is truly the last mile. That's why you have Amazon or the omni-channel distribution standpoint of the Walmarts of the world, the Targets of the world, the Amazons of the world, Amazon buying Whole Foods, Amazon partnering with Kohl's for returns, right? It's the shipping cost is going to kill, that just kills online companies, right? The cost of acquisition, the cost of sale actually to clients from online. And so that's one side of the equation. Plus I always thought about those as covered land plays. Retail is probably the worst asset class from like an efficiency standpoint of how you use land, right? You got big box buildings along the freeway, and then you got these huge parking fields as a gap, and then you got these little buildings blocking visibility, and quick service restaurants or little pads on the frontage on a 30-acre parcel right off the freeway. Like, that's crazy. Office goes vertical, multifamily goes vertical, industrial has no parking requirements really. Like, it's just the one asset class that's just fundamentally uses more land and gets less bang for buck for that. So we also always looked at that as potential redevelopment, which you started to see with multifamily being developed or kind of these live, work, play type of redevelopment opportunities. Or anyway, so that's the retail side. On the industrial side, again, onshoring was something we were looking at, and that was manufacturing. Power being an issue, we went heavy, no pun intended, into more heavy industrial. So things that had heavy power or outside storage for future development. That was early on, and then distribution as well. So distribution, manufacturing, and one of the niche plays that we've really carved out for ourselves has been in the flex space world right now because of such negative headlines. Can you still hear me? Sorry.
Yeah, I can hear you.
Because of negative headlines around office, that you have purist buyers right out there for industrial. And if it has more than 15% or 20% build out of office or lab space, it gets branded, this subcategory of flexible space. Right. And we found that there's a tremendous amount of opportunity there. So we're getting better pricing in some cases or a lot of cases for these assets that are fully functional. Right. We're getting, call it closer to, between industrial and office pricing on them. So a higher yield, and we're still getting industrial type treatment most of the time, or maybe a slight premium that we have to pay on the debt side.
Mm-hmm.
Right. So the leverage spread is huge, right? It's much greater. And also if you think about the shift of how it would work before, maybe a company had their ivory tower, 20,000 square feet of office space in that Class A office tower. And then they had all their manufacturing workforce in a distribution building somewhere, manufacturing building somewhere. Well, now with remote and hybrid, now maybe they take their 20,000 feet of office that they're using for their accounting departments and marketing team and executives, and they've cut it down to 3,000 feet for the executives and team get-togethers. And then they consolidated the rest of that 17,000 feet into 10,000 feet of an industrial building.
Mm-hmm.
Right. And so really believe that is part of the hybrid future of how that works. And it's been proving us right so far. The markets we're targeting are primary and secondary markets. We do own some stuff in tertiary, but we're typically the primary location in that market. If we're going to go to a tertiary, that's further and few between. So really primary and secondary markets, but industrial is different than retail, right? So industrial, what we're looking at are port cities, access points, transmodal transportation. So a big following in Houston. From the flex side or med tech side, we have a big and growing portfolio in Minneapolis, right? And then we own, again, call it Texas West. So in the markets we're already in and have operational efficiency and boots on the ground in, Colorado, Arizona, California, and Nevada and the Pacific Northwest. So,
and then
that's kind of
the risk profile. Are you doing core deals, core plus? I mean, you're alluding to the fact that maybe there's excess land, maybe there's some free optionality when you buy a retail center and think of it as a covered land play. I can hear that there's some value creation intrinsic in the acquisitions, but if you were to say, core value add opportunistic, where are you guys focused on the majority of your acquisitions?
Yeah. So I would say, first and foremost, we're middle market buyers, right? And I don't know if that's an overused wording or description, but call it $20 million to $100 million today. And that's expanded. In the market today, that's what the range is. In 2021, that range was 5 million to 25 million because some of the institutional buyers started getting, desperate and getting into smaller and smaller asset classes or purchase price points. But middle market, so $20 to $100 million. The quality of the asset, I would always say, is core plus. There's always a value add component that we're looking for, so it's always core plus. For us to just set it, forget it, and ride beta buying core, that's just not who we are. We're operators, we're not allocators, right? So the closest thing to something like that is recently, this last year, we bought, we did a corporate sale leaseback with Goodyear Tire, right? Publicly traded company, BB+ credit rating for one of their assets in the Inland Empire. And this asset was, in 2022, they were trying to trade for about 107 million, right? And we closed on it at 67 million.
Wow. That's awesome.
And 800 plus thousand square foot, we got it at $82 a foot in the Inland Empire at an 8 cap. Now, shorter term lease, 5-year, and good probability that Goodyear was going to leave, or, they needed actually 1.2 million square feet. And so when they leave, there's a couple things. We structured the deal where our rent was below $7 a foot, right? Our neighboring tenant, owned by one of those other letter plus REIT companies, their basis is $220 a foot.
Wow.
Their rent's $10 to $12 a foot. Our rent is $660 a foot, right? And so the type of deal that we like to do, and I think anyone likes to do, is you win if they stay and you win if they leave. So it's a win-win scenario. It becomes kind of that no-brainer. Doesn't mean there's no work, right? We're not afraid of work or having to do work into the future, but it's not a blind allocation, right? Like it's a strategic purchase that has a value add component to it, being, if they stay, we take their rents to $10 a foot, right? They leave, we put a couple dollars into this and we get $10, $11 a foot, right? We demise it if we have to. We're thinking about because we look at every acquisition for a long-term hold. Doesn't mean we're going to hold everything long-term, but we look at everything on a 10-year plus hold because we're an evergreen fund, and that's how we should look at deals. And if a deal doesn't pencil to own it for 10 years plus, we probably shouldn't be buying the deal. That's where people get in trouble, right? They have a one way in, one way out strategy. And if they don't nail the timing or nail the execution of that, then it screws up the returns. We look at it going, first and foremost, how do we lose? Our underwriting process is pretty straightforward. Let's put out all the different ways we could lose in this. Let's beat this thing up, right? And it's usually never binary in that regard. And if it is, then it's definitely a kill of a deal. But, we beat it up first, and then we look at a base case before we ever look at upside. We're always looking at downside first. And that's also operator mindset and being an operator. And it's also an alignment mindset of we don't win unless our investors win. I'm buying things that I want to buy for myself, being a large investor inside the REIT, which is alignment on top of it. And so that's an example of a deal that may seem like it's not a value add, but there is tremendous value out there.
Well,
right?
You got a good basis and you got below market rents.
And you got some excess land and there's a bunch of different things going on there, all the way to a multi-tenant, cold storage facility we bought in Houston that is Class C product, but we bought it from a family office in their 80s, last asset in Houston. They're based on the East Coast. 2 buyers fell out. We're the third buyer in the backup position, which is typical, right? We're typically not the first buyer in to win a deal. If we are, we kind of scratch our heads like, what just happened? Or, you get the buyer's remorse, like, oh, we offered too much, or are we missing something?
Uh-huh.
But typically these deals are semi off market, on market, lightly marketed, or off market, just based on relationships at this point. But, multi-tenant asset where, the ownership, again, hands-off ownership on a very hands-on needed asset that, needed some TLC for sure, with roofs and the parking lot. But, almost 500,000 square feet, we, the building, we use it all the time as an example because it just shows our differentiator, right? So call it around $40 million deal. If you see this thing, it's definitely not going on the cover of a brochure for any of the big names, right?
Yeah.
But for me, like, I look at it and all I see is cash.
Yeah.
Like, I just see, like, I love it because this is what a majority of American real estate looks like. The U.S. real estate market is like, this is middle market to the T, and we're professionalizing it. We're adding value to this. It came with an extra 30 acres. When we were going through the title report, we pulled title. This is just how hands off, right? The seller, there were 2 extra parcels with buildings on it that the seller didn't even know they owned.
Oh, wow.
The manager on site, the funny thing, the manager on site, there was a BMW on the balance sheet that no one could find. Again, family office, right? There was a 5,000 square foot building that the manager on site was using for his personal car garage.
Wow.
There's a toll booth on site, because all these trucks come in. It's a multi-tenant cold storage facility, right? So, people come in to pick up produce or drop produce. And it's just funny because, there's a gate fee and they're charging $10 and they had raised it to $15 or $20. I was like, well, how did you guys come up with the price? And they're like, oh, whatever. Gary came up with the number. I was like, well, how often do you change it? Oh, we changed that about 7 years ago. And I was like, okay. And I was like, well, do you pay by credit card or is there accounts? And like, no, they have to pay cash. Yeah. The truck drivers hate it. They have to always have cash on for this. And I'm like, so you have someone at a gate.
The guy running the gate loves it.
Yeah. Collecting cash where we could easily automate this and or have charge accounts or fobs or whatever. I mean, just come on, right? Like, so just puking cash flow out of the gate, no pun intended, and future upside. There was 30 acres that came with it. I mean, just value add on value add and value add. But to buy a $40 million asset, I can tell you my institutional competitive set won't touch this. They're not getting out of bed for under $100, $200 million deal, right? And even then.
And what was your purchase?
Call it $40 million.
Yeah, that's interesting. So you're in a completely different competitive set just because they're so large, they have to allocate larger chunks.
Well, and just operational efficiency wise, like to manage an asset like this, we have 3 people on site, right? Like, but the amount of actual alpha generation we will have from this asset is going to be huge.
Yeah.
Right. Now, to go buy a $5 million asset to do the same thing, that's probably doesn't make sense. Right. That's why. So there's some economies of scale and continued to like hone in, but it's a good example of where we play. And yeah, for us to put $1 billion out, maybe that means we have to do 20, 25 deals versus them doing 2, right? Or 3.
Right.
That's where, again, diversification in the portfolio, nimbleness in the portfolio, liquidity in the portfolio, because right now that's where the big guys are hurting, right? With their redemption queues and everything else. They have these large assets, and who's the buyer for it? It's other large allocators that aren't allocating. Yes. And that gives up. Okay, that's why we're able to buy. I mean, we're closing on an $80+ million asset this coming week. And it's going to be the largest single asset. It's a 5-tenant deal up in Portland, sold. It's going to be the largest deal this year, or it might be the largest deal for a long time, but it's the largest deal. And it's a large institutional group as the money partner selling it. And that's who we're buying.
The thing you just said about, we're operators, not allocators is maybe subtle, but it's a very meaningful distinction. I see the biggest firms as sucking up the dollars in the marketplace that, there's some principle that I'll not be able to quote right now, modern portfolio theory, right? Your allocation primarily determines your return profile. And so real estate as an asset class, Blackstone, BlackRock are just saying, hey, you've got to allocate. I've got, whatever it is, 1.5 billion of this fund available for you. And that guy says, oh yeah, okay, we'll go 1.5 billion into that. They are not thinking about, well, I'm sure I'm overstating this, but they're not a scrappy entrepreneurial guy who started as a broker and built a company and knows how to extract value. They're just saying, hey, you gigantic sovereign wealth fund, you gigantic, pension fund, you've got to allocate to me and I'll allocate to the marketplace. And I'm sure there's really sharp guys that are, like you're saying, finding alpha, but I think it's a completely different animal when you're way more pure play allocator than an operator who knows how to extract value.
I agree. I mean, I'm biased, obviously, but this is where I want my money at, right? I'm going to bet on the operator every day because it's about rubbing nickels together to create quarters, is what I always say, right? But it's when everything hits the fan. When you get a COVID, how do you handle that? When you have adversity, how do you handle it? And it starts with the boots on the ground, right? Property management, as an example, is fundamentally misaligned as a business model, right? Because you have a third-party property management is that you want to keep the tenants happy so that they pay the rent, right? So if there's a plumbing leak or a clog or something like that, you're calling the plumber that gave you the tickets to the basketball game. And they're not the cheapest, but they make your life easy and they make the tenants happy. And then you send that bill to the owner and you got to keep the owner happy enough so you don't get fired, and you collect the fees in between. That is not great, right? Like, that's not operation. And not to say there's a lot of people that outsource that. But we realized early on that we had to bring that in-house. We had to become vertically integrated. And the reason is control the money first, right? So we know where the dollars are going. That's fiduciary. And then the second is the first touch to our tenants, which is our bloodline lifeline, right? Our customer service reps are those boots on the ground.
Yeah.
And they need to be saying the same thing. They need to have an owner mindset to look at things and have 3 different plumbers, right? Or if we have enough scale in a market, having our own plumber, right? Whatever it is, but thinking like an owner, and alignment wise, to be that high touch customer service before it gets to the asset manager, before it rolls up, right?
Well, and if you just think about the incentives of the property management company, right? They're layering on residual income off of every account they bring on. They're not growing their operational base in proportion to that. They're hoping to get some scale there. The best situation for them is a check with no touch to the tenant, because it's zero marginal cost to just keep collecting that annuity. It's the worst possible experience for both the landlord and the tenant to have that person in the middle who's just collecting checks and doing nothing for it.
100% misalignment, right? So we talk about alignment all the time in the company, right? Like, I'm a big fan of mental models, Charlie Munger type of stuff, right? So being exposed to that, and it's just, you don't want to have the unintended consequences of misalignment. And so the way we structured the REIT, the way we structure our company, right? And the way we iterate, because you're not going to get the perfect fit out of the gate, and you're going to evolve and things evolve, but we continue to iterate, but it's to maintain alignment with the team. So even the way we compensate inside our company, it's about, we have our base salary or bonuses. We have a bonus modifier, which the bonus modifier is based on profitability from operating revenues, right? And then our profits, our actual profits, are promote, because we crystallize every year. We pay out into a 401k profit share. So it's not a matching, we just pay out profit share. So it's tax deferred. And now we do LTIPs, which is effectively profits, interest, or shares to our team. And that is everyone up and down in the company. That's from the office manager, right? That may not be touching the real estate, but that's helping support the team, to our property managers, to our asset managers, to our executives.
Base and then a modifier if the operating profits are above some sort of, target number. But what's the difference between profit share and the LTIPs? Profit shares on the profit that's coming from the operating company or from the NAVREIT itself?
It's both, right?
Okay.
So we take a look at the entire bucket at that point. So the way we look at the bonus modifier, it is on, call it recurring revenue fees or asset management fees or leasing, any of the overrides or one-time fee revenue.
Yep.
That we look at a ratio there to see make sure it covers all of our overhead, right? So we want it to be anything above a 1.1 or 10% profit margin that becomes the denominator, the 1.1. So anything above that. So if we're running at 25% profitability, right, it's divided by 1.1, which is a minimum 10% profitability. And that becomes the multiplier to the bonuses, right? So if you have a 50%, let's say your bonus is 10 grand, right? And our modifier is a 20% modifier. So now you're going to get 12 grand.
Cool. And then profit share and LTIPs is on
top of that, right? So profit share to your 401k. So what we want is health, wealth, and security for our team members, right? So mental, physical, emotional health. That's really important as people. We care about our people. And then the wealth side of it is, we want to make sure they're getting paid extremely well to live off of cash flow, but we also want them to build for the future or have that, right? And so that's the wealth building is, tax deferred 401k contributions directly put in. They don't have to put the money in. We put it all in, right? We typically try to max those out. That's average somewhere between 5 to 8% of someone's base, right? And then the LTIPs, we're putting up to 20% of our promote annually into an LTIPs program, right? That goes out to the team.
Wow.
So it's, again, it's just alignment. We're trying to set this thing up, Kevin.
What were the three things you said? Health, wealth, and
security.
That meaning that they know that they can be with you guys for years and years, if not decades.
Forever. Yeah. I mean, there's expectations that come with that, right? To learn, grow, and be part of that culture. But it's the security piece is knowing that we're a stable company. Hence, we're looking for profitability. We are operating to profitability, right? It's not a transaction shop. Early on, I got challenged by a couple mentors and they said, hey, are you building a transaction business? Or are you building a transaction shop or a business? And I was like, so that was I'm 28 years old at that point, right? I'm like, what do you mean by that? Like, what kind of dig is that, right? But it was a great question because, and this is not a knock on anyone, but a lot of businesses are set up. A lot of the real estate companies are set up. It doesn't matter if they're closed-end funds or whatever it is. It's buy it, build it, buy it, build it, sell it, buy it, fix it, sell it, right? It's like this same kind of hamster wheel, right? And not to say we don't sell things, but we reinvest, but it's building a business is something that can sustain that. If you don't buy any asset, you don't do anything else, but just operate your portfolio. Are you profitable? Are you able to cover your overhead? Right. And that's how we've had that same type of mantra from the beginning. There's definitely times where we're investing ahead in talent and technology and a lot of other things right now, but we're still profitable. Right.
And that would be the business, which is
security to our team.
Yeah.
Right. Like early on, we'd be trying to hire this like great talent coming from a large firm. And we're kind of like, we're a startup and they're like, can we see your finances? Like, can you open the books to me? Because I just want to make sure that like there's enough here to actually sustain this or support it.
Well, on the other side, you see like you and I have enough relationships in the industry. The guys that are merchant build or just more conventional flippers, either way, value creation itself, just like you said, when the market gets tough, like it is right now, meaning what's the terminal value of or net present value of a long dated cash flow, given that 10 years moving around, and it might be hard to start a new deal if you have to go raise third party equity. There's just not a lot of trades happening, and it's not clear what sort of terminal cap rate to underwrite. So those shops that are requiring or depending upon their acquisition fee, their development management fee, their asset management fee on deal 1, 2, or 3, when deal 1, 2, and 3 start selling and they're looking for that next one, have the problem that you're avoiding with your model, which is they've got to find a deal to kind of keep the lights on, or they're living off of past promotes, assuming there were any promotes on the last vintage of deals.
Misaligned incentives.
Yeah.
The structure effectively misaligns you. The same point with that is that that's a great recruiting sort, not just buying deals from those groups that have their promote tied up in a deal or they've given up on the deal because there's no promote anymore. But from a recruit, we buy from these people, right? Like that's our target audience. An end of fund life cycle. That's great. A single purpose, the deal we're buying right now. And it's not that it's misaligned, it's just how it's structured. It's the last asset in this total development that was a single large investment from a, large institution. The operator doesn't really want to sell because they feel like we're leaving money on the table, but the promote's tied up into it, and the equity makes the determination because they run the deal.
Yep. Major decision.
They make the major decision. They say, no, we're selling. We're making money on this and we're moving on, or we're losing money on this and we're moving on. And again, misalignment, right? Potential misalignment. I don't want to say it's misalignment. It's potential misalignment on the unintended consequences. But the other is the recruiting away. We're finding a huge opportunity where these talented people have been at a company for 5 years and they're in a vintage fund and they're the analysts, they're the rainmakers, and they're looking at this going, okay, the money's dried up because we got to recycle this money first, or we're going to deal with redemption queues. So I've moved from an acquisitions person, now I'm a dispositions person. I don't like this job. Or I'm an analyst and I've run the math and, I'm taking 80% of market for the last 5 years because I was going to get this huge promote to make 150% of market. And I'm running the math and this doesn't pencil. Like there is no promote. Like, why would I stay?
Yeah.
And so from a recruiting standpoint, we're getting talent, we're getting looks at talent and or talent. There's more talent out there than we have positions clearly today. But our bench of talent, because that's how we look at it, is we're a growing firm, right? We've been growing 50 to 100% every year. We look at our talent and we're going, okay, who's coming off the bench? Like our downtime for hiring is very low. We have a very rigorous hiring process, but the having strong team members, they're our best recruiters, and typically they're coming from referrals within and or people we've already been talking to for years.
Yeah, that's awesome. Hey, Josh, let's take a break for just a minute. Come back and we'll talk about kind of more the personal side.
Cool.
Thanks for listening to part 1 of my conversation with Josh Volen of CIRE Equity. Please listen to part 2, where we move into culture, compensation, and core values of CIRE, as well as a good bit on the more personal side around self-care and self-improvement.